Most real estate investors think getting a deal funded is entirely about the property. So they find an asset, package it into a messy, unorganized dump of 90 different PDF files, email it to a commercial lender, and wonder why they get immediately ghosted or hit with a high-interest denial. The truth is, institutional underwriters don't have the time to hunt through your files to find the numbers. In the commercial space, capital flows to clarity. Today, we are breaking down the exact 3-tier funding package framework that positions you as a sophisticated sponsor and moves your files straight to the top of the approval stack. Tier 1 of your package is the sponsor profile. Before an institutional underwriter looks at a single brick of the real estate, they look at the principle behind the deal. They are asking one core question. If this project hits a macroeconomic wall, does the sponsor have the operational and financial capacity to carry it? Amateurs try to hide their weak points. Sophisticated operators lay out their liquidity up front because they know lenders fund safety first. Your first folder must contain 3 distinct assets to answer this question before it's even asked. First, include a clean schedule of real estate owned, commonly known as an SREO. This isn't just a list of addresses, it is your documented track record. It shows the lender exactly what assets you currently hold, your percentage of ownership, the existing debt, and the historical performance of those properties. It proves you've been here before. Second, you need a verified personal financial statement or PFS. This must clearly detail your global net worth, assets, and liabilities. And third, you must show documented liquidity positioning. Underwriters need to see cash or cash equivalents. They want to know that after you close this deal, you aren't completely broke. You need to prove you have a liquidity buffer to handle tenant vacancies, construction delays, or unexpected carrying costs. By presenting this scorecard up front, you instantly separate yourself from 90% of the scattered borrowers in the market. Once the lender verifies that the sponsor is capable, they move to tier number 2, the underwriting matrix. This is where you present the actual collateral. Amateurs send over a link to a public listing and a generic summary. True commercial operators build an institutional executive summary that speaks directly to a credit committee. This folder houses the numbers, the pro forma, and the capital stack. Your asset underwriting must clearly define the debt service coverage ratio, or DSCR. Commercial lenders want to see a ratio of 1.25 or higher, meaning the property generates 25% more net operating income than the monthly mortgage payment requires. If your numbers don't show how that coverage is met, the file goes straight to the trash. You also need to visually outline the capital stack. This shows the lender exactly where the cash is coming from. If the senior debt is 70% loan to value, you need to explicitly demonstrate where the remaining 30% of sponsor equity is positioned. Lenders want to see your skin in the game. When you show them a perfectly balanced capital stack alongside documented market comps and an itemized construction budget, you eliminate their work. You make it incredibly easy for them to say yes. But here's the section that turns a good package into a bulletproof package, and it's the one tier almost every independent investor skips. Tier number 3, the contingency map. Lenders don't care about your best day scenario. They already know how the deal works if everything goes perfectly. Underwriters get paid to protect the bank's downside, which means they are constantly calculating your failure points. Your job is to prove you've already calculated them too. This folder contains your multi-layered exit strategies. You must clearly document Plan A, Plan B, and Plan C. Plan A is your primary exit, typically a long-term commercial refinance or a traditional sale based on this stabilized value. You show the exact underwriting benchmarks required to trigger this exit cleanly. Plan B is your secondary contingency if interest rates spike by 200 basis points and a traditional refinance doesn't pencil out. You must show that the property can still cash flow as a medium-term rental, or that you have the capacity and structural relationships to extend the bridge debt. Plan C is your worst-case exit, such as an immediate liquidation framework, or bringing in an institutional equity partner to recapitalize the asset. When an underwriter sees that you have stress-tested your own deal against rising interest rates, construction overruns, and extended lease-up times, the perception of risk vanishes. To truly understand why this 3-tier framework dictating sponsor capacity, asset underwriting, and contingency mapping is non-negotiable, we have to look at how a commercial credit committee actually analyzes a file behind closed doors. When a loan package lands on an underwriter's desk, they aren't looking for reasons to approve it, They are actively hunting for the single risk factor that allows them to deny it and clear it off their plate. Let's look closer at how Tier 1, your sponsor profile, safeguards your file against the most common institutional objection, the character and liquidity gap. When a lender reviews your schedule of real estate owned or SREO, they are looking for asset alignment. If you're requesting a loan for a commercial retail strip center, but your SREO only shows single-family residential flips, a red flag goes up. By organizing your SREO to highlight relevant operational scale and pairing it with documented global liquidity, you prove you have the financial stamina to manage the specific asset class you're trying to capitalize. You aren't just asking for capital, you are proving you are a safe bet to return it. Moving into the Tier 2 metrics, independent operators frequently fail to realize that a property's debt service coverage ratio isn't a static number. Underwriters will actively stress test your pro forma against market realities. They will run sensitivity analysis, artificially raising your vacancy projections by 5 or 10%, and swapping your estimated insurance costs with historical market highs. If your baseline underwriting matrix is already sitting at a razor-thin margin, these institutional adjustments will push your file below the mandatory 1.25 threshold, resulting in an automatic rejection. By organizing your capital stack with high sponsor equity positioning up front, you signal to the committee that even under severe market compression, the senior debt remains protected. Finally, the inclusion of the Tier 3 contingency map addresses the ultimate institutional fear, the bridge loan extension bottleneck. In volatile economic cycles, standard exit strategies evaporate quickly. If your primary plan is to refinance out of a short-term bridge loan, but the commercial debt markets tighten up, an underwriter knows you could be headed straight toward a technical default. By presenting documented execution paths for Plan B and Plan C, proving you have the secondary liquidity to absorb a rate spike or a prearranged equity partner ready to inject capital, you shift the conversation from defensive risk management to strategic execution. Ultimately, this entire process comes down to a fundamental truth in corporate finance. Lenders fund safety, lenders fund clarity, and lenders fund structure. When you deliver an unorganized file, you're asking the lender to do the underwriting work for you. When you deliver a bulletproof 3-tier package, you're delivering an investment-grade asset presentation that commands respect, dictates terms, and secures the capital your business requires. Remember this, it's not about how good the deal looks on paper, but how safe it feels to the committee. Lenders fund safety, lenders fund clarity, lenders fund structure. By delivering a 3-tier package built on sponsor capacity, tight underwriting, and bulletproof contingencies, you give the lender the one thing they actually want to buy: safety. If you want to pull down the exact folder templates, checklist matrices, and underwriting frameworks we used in this video to build your next capital request, click the link in the description below. Let's build your capital pipeline the right way. Don't forget to like, subscribe, and drop your questions in the comments below. We'll see you in the next masterclass.